Welcome back, investors. Have you been looking at the stock market and feeling like all the good opportunities are gone? Well, look no further than the high seas. That's right. The cruise line industry, once left for dead, is now making an incredible comeback, and it's presenting what many believe to be a once-in-a-decade buying opportunity. But with multiple players in the game, which cruise line stock has the strongest wins in its sales? In this video, we're setting sail to analyze the 3 most attractive cruise stocks right now. We'll break down the strengths and challenges for each company, dive into what top analysts are saying, and explain why the entire industry is positioned for such smooth sailing ahead. Let's dive in. First, let's talk about the big picture. The cruise industry's recovery from the pandemic has been nothing short of remarkable. We're looking at projected record passenger numbers for 2025. Consumer demand is robust, people are prioritizing experiences, and that is fueling a very strong growth outlook for the entire sector. This powerful tailwind is the foundation for the bullish case on cruise stocks. The opportunity is clear. We have growing demand, a rising earnings outlook, and for some companies, valuations that analysts still find attractive, especially for long-term investors. But it's not without risks. The major challenge for these companies is the high debt levels they took on during the pandemic. Investors need to be prepared for some volatility, as the stocks can be sensitive to economic concerns or geopolitical events.
Carnival Corp., ticker CCL. Carnival Corporation is one of the world's largest leisure travel companies and a leading global cruise operator, owning a portfolio of world-renowned brands that include Carnival Cruise Line, Princess Cruises, Holland America Line, and Seabourn, among others. Headquartered in Miami, Florida, but duly listed in both the U.S. and U.K., the company's operations primarily consist of providing vacation experiences through its fleet of vessels that sail to diverse destinations across the globe. Its core business model revolves from generating revenue from passenger tickets, which cover accommodations, dining, and entertainment, as well as from a significant portion of onboard spending such as casinos, spas, shops, and excursions. Despite facing profound challenges, most notably from the COVID-19 pandemic, which led to a complete operational halt and substantial debt accumulation, Carnival has been focused on a recovery path, optimizing its fleet and leveraging its extensive scale to return to profitability and capitalize on the sustained demand for cruise travel. First and foremost, analyst sentiment is overwhelmingly positive. The consensus rating is a moderate buy, and this isn't based on vague hopes. It's backed by 21 buy ratings with precisely 0 sell ratings. This shows a strong vote of confidence from the market. The average price target sits around $33, which implies a potential upside of over 16% from the current price near $28.30. Secondly, the fundamental business recovery is in full swing. Carnival is riding a powerful wave of demand in the travel sector. This is reflected in steady revenue growth and a remarkably strong return on equity of over 25%, which tells us the company is using shareholder money very efficiently. Perhaps one of the most encouraging signs is the company's financial health. Carnival has generated substantial free cash flow, nearly $2 billion. This provides a crucial cushion for reinvesting in the fleet, funding marketing, and most importantly, paying down the significant debt it accumulated during the pandemic. Finally, its business model is a key strength. Carnival isn't just one cruise line, it's a diversified portfolio of brands with a global reach. This allows it to capture demand across different market segments and geographies, making it a well-rounded play on the global leisure travel boom.
However, no investment is without its risks, and with Carnival, there are some significant points of caution that you cannot ignore. In technical picture, there are signs of short-term volatility ahead. Key momentum indicators, like the RSI, suggest the stock may be overbought in the near term, while the MACD is flashing a bearish signal. This doesn't change the long-term story, but it does suggest we could see a price correction or a period of consolidation before any further sustained gains. It's also important to note that Carnival is not a stock for income investors. It currently pays no dividend, as it's prioritizing cash preservation for operations and debt reduction. While this is a prudent strategic move, it does limit its appeal to a segment of the market. Finally, investors must remain aware of broader economic and sector-specific risks. High debt levels, while being managed, are still a concern. Any new disruptions to global travel or an economic slowdown could quickly impact consumer discretionary spending on cruises. In summary, Carnival Corporation presents a classic case of high risk, high reward. The bull case is powerful. Strong analyst support, a robust industry recovery, impressive cash flow generation, and a diversified global business. But the bear case is equally compelling, centered on an extremely rich valuation that leaves little room for error and technical indicators pointing to potential near-term turbulence. The final verdict from the data seems to be this: Carnival stock offers significant upside potential for investors who are bullish on the long-term travel recovery and believe the company can meet its lofty growth expectations. However, it demands a careful, balanced approach, and investors should be prepared for a potentially volatile ride.
Royal Caribbean Cruises, ticker RCL. Royal Caribbean Cruises is a global cruise vacation company and one of the world's leading cruise brands, operating a diverse fleet of innovative and technologically advanced ships. The company's portfolio includes its flagship Royal Caribbean International brand, known for its Icon, Oasis, and Voyager-class ships that feature groundbreaking amenities, as well as the premium Celebrity Cruises and the luxury Silversea Cruises. Headquartered in Miami, Florida, its itineraries call on all 7 continents, offering vacations ranging from short getaways to world explorations. As a publicly traded entity, RCL focuses on delivering exceptional guest experiences, driving operational efficiency, and pursuing strategic growth through new ship introductions and private destination experiences like Perfect Day at Coco Cay, all while navigating the dynamic global tourism and travel industry. First, let's look at the bull case. And it's a strong one. Analyst confidence remains largely bullish, with a consensus rating of moderate buy. This is backed by numerous buy and strong buy recommendations. The average price target sits between $334 and $368, suggesting a potential upside of 17 to 22% from current levels. That's a significant vote of confidence from the pros. Explosive growth. The fundamentals are solid. Royal Caribbean is showing strong earnings growth, with forecasts for adjusted EPS to surge over 30% in 2025. Revenue is also growing at a robust rate of nearly 13%. This isn't just a recovery, it's a powerful expansion. Strategic edge. The company isn't just riding the wave, it's creating it. Their focus on premium experiences, a modernized fleet, and unique offerings like private islands and new travel routes gives them a competitive moat and allows them to command higher prices. Financial fitness. Critically, Royal Caribbean has strengthened their balance sheet, regaining an investment-grade credit rating. This lowers their cost of capital and signals financial health to the market. Combined with improved operating margins, the financial foundation is firmer than it's been in years. Robust demand and attractive valuation. Despite economic whispers, passenger demand remains strong, with record booking patterns. And even after its run-up, the stock's valuation isn't stretched. A forward PE ratio around 19 is considered reasonable, especially when compared to its industry peers and its own growth trajectory.
However, no investment is without risk, and Royal Caribbean faces some notable headwinds. Cost pressures. Elevated operating costs, particularly for fuel and food, continue to pressure profit margins. This is a persistent challenge that can eat into those impressive earnings gains. Economic sensitivity. As a discretionary travel company, Royal Caribbean is exposed to economic downturns. Inflationary pressures and a potential pullback in consumer spending could directly impact demand and booking volumes. Competition and regulation. The cruise industry is highly competitive, requiring constant marketing spend. Furthermore, Regulatory changes, like a rising cruise tax in Mexico, can affect itineraries and squeeze margins with little warning. Financial leverage and capex. The company still carries a high debt load, and significant capital expenditures are required for ongoing fleet investments. This limits near-term financial flexibility and means a lot of cash is being reinvested back into the business. Technical caution. From a trading perspective, some technical indicators suggest the stock may be overbought in the short term, which could lead to a price correction or a period of consolidation. So, what's the final verdict? Overall, Royal Caribbean presents a compelling case of strong growth potential driven by a solid industry recovery and superior strategic positioning. The analysts' optimism and reasonable valuation are hard to ignore. However, investors must go in with their eyes open to the challenges: cost pressures, economic risks, and the company's substantial leverage. For a long-term investor who believes in the resilience of the travel sector, RCL appears well-positioned to navigate these waters. But for the faint of heart, the short-term volatility might be too much to bear. Ultimately, it's a story of high growth potential, but not without its set of calculated risks.
Norwegian Cruise Line Holdings, ticker NCLH. Norwegian Cruise Line Holdings is a leading global cruise company and one of the world's 3 largest cruise operators. The corporation operates a fleet of vessels under 3 distinct brands: its namesake, Norwegian Cruise Line, renowned for its freestyle cruising concept offering flexibility and freedom; Oceania Cruises, which provides upper-premium culinary and destination-focused experiences; and Regent Seven Seas Cruises, an ultra-luxury, all-inclusive, all-suite brand. With its headquarters in Miami, Florida, the company's business model revolves around providing cruise-based vacation experiences across the globe, generating revenue primarily from passenger ticket sales and onboard services. As a publicly traded entity, NCLH faces the cyclical nature of the travel industry and is subject to factors like fuel prices, global economic conditions, and geopolitical events, all of which influence its operational and financial performance. Starting with the bull case, there's a lot for investors to like. Analyst sentiment has turned notably optimistic, with a consensus rating hovering around moderate buy. This is backed by a number of strong buy and buy recommendations. The average price target sits between $31 and $35, which, from current levels near $23, implies a substantial upside potential of roughly 35%. Fundamentally, Norwegian is often flagged as being undervalued compared to its peers. This isn't just a gut feeling, it's supported by strong value scores across several analytical frameworks. The earnings outlook is positive, with projections for double-digit EPS growth and solid revenue gains in the coming quarters. To bolster its position, the company's recent equity offering has strengthened its liquidity, enhancing financial stability to support operations. And strategically, Norwegian's broad global presence and diverse brand portfolio, including Oceania and Regent, position it well to capitalize on the industry's recovery and tap into new demand segments. For the truly long-term investor, some forecasts are even more bullish, suggesting a path to $40 by 2027 and much higher levels by the end of the decade.
However, and this is a big however, you cannot look at NCLH without acknowledging its very real challenges. The most significant headwind is its balance sheet. The company carries a high debt load with near-term maturities, which constrains its financial flexibility and presents a clear risk. Adding to that, Norwegian is still experiencing negative free cash flow to the tune of over $750 million. This indicates the company is still burning cash, which could pressure its resources if it persists. We've also seen some unevenness in its recovery, with a slight contraction in revenue of around 2.9%, suggesting some markets or segments are lagging. From a technical perspective, the stock is currently trading below its key moving averages, signaling caution and some bearish momentum in the short term.
And of course, the company remains exposed to broader economic risks like inflation and competitive pressures, which could impact future bookings and profitability. So, to summarize Norwegian Cruise Line, you have a company that is fundamentally undervalued with significant upside potential, according to analysts, supported by improving operational trends and strong brand strength. The opportunity for a powerful rebound is clearly there. But investors must be cautious. The high leverage and ongoing cash burn are serious concerns that require careful monitoring. It's a stock that could offer fantastic returns, but it's not for the faint of heart.